recording. Yeah. So we are ready.
Okay. So hi guys. Thank you for this meeting. I'm I think one of the first investors in Debitum.Network. I started more than a year ago at the beginning of last year, and I'm quite happy with the platform, even though I started with a lot of reservations about the platform, because I always very cautious and prefer to go with some established platforms and try the platform very cautiously. I started like a test investment with 100,000 euro just, and for 6 months I tried the platform, like the results, and currently I almost triple my initial investment, and can share that the results are very good for me, because it's about my return on investment is about 9%, which is very good for this kind of platform. I mean, SME loans platform. But currently, I want to focus more than on risk sides of investing, not the return side, because in crisis, investors usually start thinking not just for a return on capital, but the return of capital. So it's currently more important for most investors. And the first question is to start discussion for me is that Debitum is a relatively young platform. It's I think 2 years, and very important for investors are loan originators on one side, but on the other side it's the platform financial help. I assume that Debitum is still burning money, not profitable. This is my assumption. If it's not correct, you can correct me. But I remember there was an ICO at the end of the 2017, I think, and I think you raised some good money on this ICO. And I would like to know how big is your cash reserve and what is your burning rate. So let's say if your business goes down, how long you will, let's say, how the platform, how long it can survive if you don't do new originations and there is a big withdrawal from investors. I mean, how is the burn rate and how big is your cash reserve? Maybe to clarify the question.
Yeah, I can. First, I would like to start with like greeting you. Thank you very much for this opportunity to speak with you, and thanks for being our investor. We appreciate that. And yeah, in this time, as we discussed with you like before, it's very important to save investment, and the question that you raise are very important for many investors. So for us, yes, you're correct. We raised initial capital when we did ICO, and we still have good equity. We have enough funds. I would say like around 700,000 euro. That's the volume that we have. In the worst case scenario, our burn rate right now would be, okay, so now we actually burn more or less 30,000. If we increase a bit expenses, so it would be like maybe maximum to 50,000 per month. So that will gives us possibility to survive even in a worst case scenario during next 15, 18 months. So that's quite good reserve for us.
Yeah.
So I believe we will overcome.
Okay. One more question about your operating expenses. I read the white paper about the ICO before, and I got the idea behind this blockchain construction. I presume, maybe it's not correct, but is your operating expenses dependent on, let's say, price of Ethereum? I think the blockchain is Ethereum based or not?
Well,
what if the Ethereum price skyrockets with your operating expenses?
Look, at the very beginning, yeah, there was idea of blockchain will be in each operations, but now our current operations, they are not connected to blockchain, and only DEP token is connected to blockchain. Because when we analyzed everything, like every small transactions, like minimum transaction on the platform is 10 euro, and it is very cost inefficient if we use that for like everyday transactions. So we don't use that for daily operations. And it appeared that our investors are not, they actually didn't want it to happen. So there is no need to work.
I also prefer it to happen, yeah. Yeah. So you don't use blockchain for any transactions?
No.
Maybe just for this third parties like loan originators.
We use it. If you notice, we have a loyalty program launched on the platform recently, DEP token. So for those transactions, when we have those external transactions, we use blockchain for those transactions. And that's it.
Okay. One of the reasons that I joined the platform first was this DebInfo loan originator on Mintos. How is this DebInfo loan originator connected with the Debitum? I don't see this originator on the platform anymore, but at the start there was DebInfo. Looks like there was some merge happens or something. What is the relation with DebInfo?
Very, very good investigation was done from your side. Yeah, DebInfo is Lithuanian factoring company, which was founded by Martins, Donatas, and Justas, 3 shareholders who initially founded Debitum as well. But then in 2018, DebInfo was purchased by Factories. It's a factoring company from Netherlands. And now that company, Factories, is our loan originator on the platform. They have business in Netherlands, in Lithuania, and in Latvia. And at that moment, there was a split between shareholders because 2 of Debitum founders, Donatas and Justas, they decided to continue with Factories, and they left Debitum. And Martins exited DebInfo, Factories, the company that became Factories, and he concentrated on Debitum. So currently, DebInfo is part of Factories group, and we appreciate that this loan originator, we work with them and they are still on our platform.
So part of Factories loans are currently DebInfo loans?
This is exactly Factories Lithuania, that's DebInfo.
I see.
So when the company was purchased, they changed name and they joined the group.
Okay. One thing that I love about Debitum is the way that Aforti, which was one of the first originators on the platform, also just suddenly disappeared from the platform without any explanation for me back then, but without any losses for me as investor. And later it happens there is something not very good around Aforti. So I would like to know how you detect these problems about Aforti in long before DebInfo and later Mintos, maybe 6 months before, I think, or maybe not 6, but 5 to 4 or 5 months before. And how you spot these problems? What is the red flags that you see in Aforti to disappear from the platform?
Okay, so I believe I can comment on that because I was fully responsible for the case. So I would say, yes, so I'd say there were 3 key factors in the Aforti case. So one of the factors was asset performance on the platform itself. Those 3 loans which we have, actually, if I remember it correctly, there were only 3 loans on the platform. The second was communication from the Aforti side regarding assets. And the third key, I believe, component in the whole decision-making process was the loan book performance of Aforti and financial performance. So if we come back to the first point, so that was our first alert. So we uploaded our assets as a test run, and we believed in this loan originator based on our, let's say, initial due diligence results. That's okay. Let's try to put some assets. We agreed on the terms, and we put their assets. Everything was okay until we started noticing some, let's say, irregular repayments and lateness appear on this, let's say, very small sample of loans already. So, and fortunately, at that time, it went together with the fact that we always do monitoring processes on our loan originators. So that was exactly maybe 1 month or like 2 months after the Aforti uploaded assets on the platform that we and me and my team decided that, like, okay, let's do monitoring processes on the Aforti, meaning that we just reinitiate the whole due diligence process on them. So that's what happened. We acquired the financial data from Aforti and acquired their loan book data, and we of course started digging in it. We noticed some small issues, let's say, with those loans. Some like loans they were collecting worse, some were collecting better, terms were maybe a bit unstable. So we started communicating those issues with the loan originator, with Aforti. And actually, what happened? We did not like their answers because they were, in a way, I mean, this case is already like a public new. So they were like avoiding answers, let's say, in a way, avoiding and not answering this straightforward. So that was already, let's say, like an orange flag. So we continued with the analysis, and we applied the key ingredient of the whole analysis was a tool called Cohort Analysis, which I will present later in this discussion. So what that showed to us that the consistency of the collection, let's say, there is one part of the loan book where like what loan originator plans to collect, and there is another part what the loan originator actually collects. So we started matching every transaction and every loan with the appropriate payments, factual payments, and we started noticing some gaps in the payments. And those gaps, you know, for one loan, it's not a big issue. For two loans, also, Aforti is huge. But when you start noticing that as a consistent trend, that's an alert. And then you check their financial data, and there is a very simple question: where are they going to get money to cover all those loans and all those gaps? And we just essentially came to the conclusion that there ain't any to collect that gap, that they actually like operating at the level where they cannot, you know, accept like more default. So we started raising those questions. Again, the orange flag, which I previously mentioned, became into red flag because they were just not answering questions. Basically, they were just avoiding them in a sense. So we immediately informed Aforti that, sorry guys, we cannot work. The risk is too high, and we are not sure how you will be doing. Of course, we were like, we went like 100% sure. That's for sure. I mean, because no one, as you mentioned, Mintos, Viventor, no one have been talking about the case yet. Yeah, and we were like, okay, these platforms are good, established, and they're not talking about the case. But we just trusted our methods, and eventually that came on the very bright side for our investors and our platform as a whole.
Yeah, this is the thing that made me triple my initial investment, actually. When I saw that how the situation with Aforti goes on Viventor and Mintos, where I also invest, I was very pleased with the fact that Aforti is gone from the Debitum, but I just wanted to know how this happened. Maybe it can be luck, of course. But,
I'll show you the examples, and you will get even like better idea how the process works.
Okay, so one of the big pluses of Debitum, I always stated when they ask about my opinion, is that Debitum somehow detected Aforti at very early stages, which doesn't happen on much established and like Mintos is kind of synonym of P2P lending in Europe, but they were very late in this process. Actually, I studied they stopped primary loans initiations long before they told anything to investors about the problems, but anyway, it was quite late, I think. Okay, speaking about your due diligence process, I will like to know, besides Aforti, how you select your originators, how you analyze all the data, and maybe some details on your due diligence process, and something which is more important now is after initial evaluation, how often you re-evaluate them.
Yeah, I can start with the pre-selection process and eligibility criteria, and then later Gytis will describe how he assesses risks and how we do monitoring. So, as you know, we work only with SME, small business loans, invoice financing, and so for us, always important that the final payer is a business or like from income generating company. The loan or invoice is repaid. How we pre-select? We actually, first of all, we have a first interview checking when they started, when loan originator started business, which area they work, what is the experience of the team, how big is the company, and how stable is business model. So for us, it's important to understand like the whole loan origination process, how they originate loan, how they collect, do they have experience in both sides, in loan origination and in collection, how they assess their risk. And then like separately, we look at financials to see how strong is financial part of the company. The business should be operationally sustainable and scalable. So we check all those details. And just to give you an example, for example, they disburse loans with interest rate 20%, cost of fund, let's say 10%. So 10% margin has to cover their operational expenses, default rate, and profit. They have to earn something. So if you see that, for example, in their business case, they have default rate 10% and cost of funds 10%, and they disburse with 20%, then we have question how you cover all your operational expenses, etc. So then we structure the deal. When we structure that, we also need to understand if our product, if our cost of capital is appropriate for this business or not. And only if all those criteria match, we can move to like deeper due diligence. Well, of course, we also check top management and shareholders if they are in blacklist, if they're politically exposed person, etc. So we have like many pre-selection criteria, and then if everything is fine, we collect data, we take loan book, and then our risk assessors they work on that. So I will ask Gytis to comment how he analyzed after that.
Yes. So what Sergei mentioned, that's as a standard process we do pre-selection. So one of the part I will share my screen for sure. Yes, so I can show visually. Yeah. So this is our due diligence questionnaire, which has to be filled by every loan originator. So this questionnaire covers most parts, which Sergei has already introduced. So how do they onboard their clients? How do they score them? Because we also evaluate the scoring process of the loan originator, how well they are doing. For example, if they're using some in-house credit scoring model with some, let's say, simple Excel formula, then we evaluate that, let's say, as a low quality. And if a loan originator uses like third-party, highly reputable services, we are very happy to see that. Then we evaluate debt collection process. How do they do it? Do they pass it to some collection agency? Do they do that in-house? Then we evaluate operations, and that's where the loan book analysis comes in. And then we move to financials. So this is the basic data which we gather, let's say, initially, in addition to loan book and financials. So when we receive the data and Sergei and other colleagues from the loan originator team processes it, we move to the scorecard, which looks like that. So it's a very detailed view of the company, and we evaluate as many aspects as we can, as many relevant aspects of the loan originator as a company, which would be relevant for our investors. So we move along with these criteria. We evaluate all information we gather, qualitative and quantitative pieces of information. So these include, as you see, portfolio analysis, and then financial data analysis. And then like at the very end of this like whole processing, we arrive at the score, which determines whether we onboard the loan originator, whether we can take the initial, let's say, approval of the loan originator. So as I mentioned previously, I will show the key components which we use in the risk analysis. So this is one big part is loan book and financials analysis in terms of sustainability of the company, and then capital adequacy and sufficiency to ensure buyback guarantees, which we offer for all of our assets. And we try to keep this trend that we do not want to move to riskier side of the assets. So I will show a summary statistics, let's say, page. So here you can see various statistics which we evaluate, including monthly issuance versus monthly turnover, how much loan originator collects, how their portfolio grows, how their outstanding portfolio evaluates throughout the time, what are the latenesses of all loans. Then we do the calculation of operational costs and incorporating default rate in that. So we gather all these little pieces of information, and then we arrive at one of our key components of our due diligence process, and that is the example I mentioned previously, which actually revealed issues with the Aforti. So then we compare their collection performance based on their on the time when the loans were issued and on the time when they had to be collected. So here we can see how consistently the loan originator manages to collect what is planned. Basically, if that percentage would go down to, let's say, below 100, that means that here is a more detailed example. So we see every loan here, and if the planned collection was higher than the factual collection, that means that loan originator simply does not collect what he had to collect. That means losses. If we accumulate enough of such transactions, then we have an issue, as let's say Aforti had the same. Then we have some liquidity issues later on. And this analysis has been proven and shows like very good success rate, because we had we try to do that for every loan originator, despite the industry, the product they offer, or any other factor which might deviate us from such analysis. So, and we also, let's say, in the past 50 due diligences or 40 due diligences, which I had like last year, we had like quite a few cases where loan originators couldn't manage to pass this step of analysis. So then, including all those things which I showed, we estimate the default rate, which might appear if we onboard the loan originator. Also, we estimate default rate, which could be reached if the loan originator does not use our services. So basically, we estimate the sustainability of the business if the business model actually works. Then we use loan book data to actually adjust financials. Of course, that sounds very straightforward and simple, but that shows a very clear picture of the loan originator financial performance, because in this industry, in this financial industry, companies tend to use interesting accounting techniques, which allow them to, which allow them to, let's say, adjust the revenue, their expenses. Some can be written off. We don't like that. We try to get the real picture. And data helps us to actually evaluate how much, let's say if the company is a startup and we had some cases, how much they can actually burn, and how much they can bear, and things like that. And we also usually we get procedures description of the loan originator, and there are some set rules. And we go to we try to identify each individual case which does not go along with the procedures, and we ask, why are you doing that? Is this client special? Is this client somehow related to the company? Is this client related to top management, which we also evaluate their experience? For example, we would not like to see a CEO of an established lending company who has, like, let's say 5 years of experience in lending and previously was doing some other things. No one would like that. We don't like it, and our investors also would look sketchy at such experience of the management. And then at the very end, if everything operationally passes, we move on actually establishing covenants and ensuring that the company can provide buyback guarantee. Meaning, if the company has enough capital, which is not pledged to some other parties, which can be accessed by us and actually offered to our investors as the second source if something goes bad in an unlikely event, let's say, of a default of loans or similar occasions. So after establishing that, we then go to negotiations. If we get the positive answer from our analysis, we hold a credit committee with our team, including Sergei, Martins, LO team representatives, and me. And then we move on actually establishing limits for the loan originator. For example, debt to equity ratio needs to be, depending on the industry, at a certain level that, for example, company could actually bear such debt. And if we have, let's say, skin in the game rule that will not breach any covenants and that the company actually can maintain such level, as Sergei previously mentioned, because in debt and equity goes everything: operational costs, default rate, and actually we need to establish if the company can bear such figures. Then we also establish a covenant usually on the default rate. Let's say if we see on the loan book that the default rate is 4, we do not like to see a drastic increase in that. So we usually establish, let's say, 5% default loan rate. And then we go on the operational sustainability, seeing how the loan book actually grows together with their profit. Let's say if the loan book goes drastically and their profit does not go at the same pace or at the similar pace, that also is an issue, because that means that the company is issuing more loans but actually not collecting them efficiently. And then when we agree on these covenants together with the team, then we go to the loan originator and actually make an offer to collaborate with Debitum.Network. And that basically concludes our due diligence process. And one thing to mention, actually, before actually agreeing with the loan originator about the outcome of our credit committee, we do actually a field visit where we talk with the top management. For example, we had a case in Romania where we flew and we talked with the representative of a few branches. Let's say we went to different cities to actually talk with them, but not top management, not CEOs, CFOs, but with people who are actually involved in everyday operations of the company and actually understand how they work, what they actually do. Because, sometimes policies, they look nice, they look beautiful, but no one is actually, going along with them. Maybe they are not doing something. But fortunately, with that case in Romania, everything was done nicely, and actually the branch managers, they confirmed that they're doing that. And then if we get positive results on everything, then Sergei or anyone else goes with a happy handshake and sign the agreement, and we have a loan originator on our platform.
Okay, thank you. It was impressive. I never get such details
Yes.
when I ask about this question.
And if I may interrupt you, I forgot to mention, like, how often do we do that? So on normal circumstances, we used to do that on quarterly basis. So basically reinitiating all the diligence process. Of course, we do not reinitiate pre-selection and the deal structure, but we go through the financial analysis. during these times, we do that each month or even more often. Like in some cases, we already have done that like each 2 weeks. And we are really now closely looking at that. Like when the situation might become stable again, if we see no, let's say, extraordinary events in the market or anything else, we believe we will move again to quarterly monitoring, but currently we do that very often.
Okay, it's very, very important to know that you have monthly all this financial analysis. And I tempted here to ask about, because there were already 2 months past when this COVID-19 situation, and probably we have 2 months analysis of the portfolio. Is there something that investors should be aware of? Is there some next Aforti cooking somewhere? Or is there any problems we can expect with the loan originators? And maybe who is in your opinion, the safest loan originator and the riskiest loan originator on the platform?
Okay, so in terms of the total market, I would be lying if I say that like loan originators are like growing as they used to grow. Of course, there is a downward trend. Some loan, the issuance is a bit slower for loan originators and things like that. But we keep that in mind. You know, we do not punish our loan originators just because they cannot issue that much loans. What we care about is quality. So we have checked all the covenants. We checked the loan books. So everything seems okay. Like there are no issues. With, of course, there are some more delays. Let's say in invoice financing companies, they tend to take advantage of the grace period. And that is, let's say, fair enough because companies then can take some more time to cover the costs of factoring. Of course, on our platform, we do compensate for the grace period. So that is a common misconception for our investors. So for grace period, you do get interest. So, and there are some, of course, peculiarities, and the final borrowers, they tend to take advantage of those. Yeah, so I believe on our platform, everything is fine. That like, of course, we, from our side, we do checks now on the final borrower. We did not do that. We didn't do that previously. Now we do final checks also on the final borrower because we want to check if actually loan originators have not started, you know, issuing risky loans just because it's tough times. So we do those checks. Also, we control the exposure to the platform much in a stricter manner. So we are not like, let's say, accepting all the loans. For example, we had one case with our one loan originator when he provided asset for funding for us. And that asset, we went to the checks of the final borrower, and we see that the credit rating is actually downgrading. That like in time, there was, let's say, for example, B+, and now we see that it's going C-, D-, and it actually signals that there are some issues with this final borrower. So we immediately informed loan originator that, hey, we do not like this asset because the final borrower looks to go into default. So again, with the timely notification for the loan originator, we managed immediately to close the asset, get refund for our investors, get settlement from our loan originators. So all in all, we are at zero balance. Everything is covered, no issues, and no problems with that. So that our monitoring actually pays off. So we control that, we limit the exposure, we're not blindly taking every asset they provide. So what investors should be aware of, I'd say that investors should actually read the descriptions more closely, I'd say. Actually understand what they are investing in, because investors, they usually tend to be angry if the assets are late. But for example, if you invest in logistics sectors, the logistics sector, that doesn't mean that the company itself, let's say, is an established company who has like a fleet of 50 trucks. No, it's a really low chance, let's say, that the company would go bust in 1 month. So, but there is it's fair to expect like a higher delay for these loans. So I'd say investors should get more information about their investors. We provide that on the platform, and that can be easily obtained on the asset detail page. So I'd say that investors should look closely to those assets, and also check the evaluation criteria of the platform itself, because this whole industry is based very much on trust. So if the platform blindly accepts all the assets, and let's say if there is an increase of assets of specific loan originator, suddenly that might signal that some of those loans are of lower quality.
Okay, thank you. Thank you. That is a good suggestion. And I can share my experience on this. I just tried the auto invest with very small amount just to try if it works at all. It works, but I never auto invested on your platform. And when I invest in business loans, I never use auto invest, because for me, business loans are usually riskier than the consumer loans. Because it's a lot of, usually it's easier to go away with, let's say, 200,000 loan, than you go away with 200 euro loan. So I prefer to use manual investing, and studying the asset is only possible in manual investing also. I would like to ask one more question about when this topic with lower originators. About the possible conflict of interest. I saw that chain finance, it's a SPV. It's actually owned. I understand it, like it's owned by the platform. And also this factories is also very related to the platform. Nothing wrong with this, but I would like to know if there is some possible conflict of interest when you evaluate these originators, and how you can, maybe you have some KPIs or some things, how do you prevent this possible conflict of interest here?
Yeah, so let's speak about chain finance and factories separately. So as I mentioned about factories, it used to be there before, and at the very beginning shareholders were the same. Now there is no overlapping of shareholders. And actually, Martin Schliebers, who is the founder of Debitum, he still has like up to 2% in factories, but it's like very, very minor share, like 2%. He cannot influence any decision there, and vice versa. Yeah, and there is not his interest to promote factories. We have some internal rules, so we don't have like higher exposure than certain percentage. Well, to be honest, when Debitum started, you probably remember there was only actually factories, and that was when we started. Now, factories exposure on Debitum, I would say maybe 20% of total portfolio. And we set internally, so we would like to have like a diversification through our loan originators, and that's why you will not see like we are trying to promote factories more than others. So there is no case like this. They have the same covenants like other loan originators. So with factories. But on the other hand, close relations with Lithuanian team helps us to see, and like to keep an eye on those assets. Like if something goes wrong, we will be the first who will notice that. So that I would say even advantage of good relations with factories. Yeah. As to chain finance, yeah, correct. That SPV that we used at the very beginning when we had the SMEs, which we wanted to invest in. But since we concentrate now on scaling our business as a platform, we actually don't have chain finance on the platform right now. And we don't have any loans from chain finance. So everything that was disbursed before is repaid, and I think we will not have any new loans.
Okay, so basically chain finance is gone as a loan originator. I remember this from the first stages of the platform. It was one of the main originators. I don't mind to invest in even like platforms like Bondoro, which is actually the sole originator, but I just wanted to know if you expect something like this to be in some kind of conflict of interest. And one of the maybe last questions, I hope, is about you're applying for investment company license in Latvia. I read about this license, but there were a lot of discussions in certain groups in Facebook about P2P, and I would like to clear something about the one of the biggest, maybe biggest advantage for the investors. This guarantee that will guarantee the 90% of the investors' money up to, let's say, to 20,000 euro. Okay, just to clear one question. If I have invested 5,000 euro in a single loan on the platform, and loan originator go bust and cannot make the buyback guarantee, it's worst case scenario, what will happen with this 5,000 euro? Should be repaid by the government agency in full, or just 90% of them, or nothing will be repaid back to the investor?
Okay. To answer quickly, there is no answer so far. Honestly, last week actually there was a seminar for platforms, and Martin Schliebers, our co-founder, participated on that online training, and he actually asked that question to regulator, because in legislation is written that regulator will decide whether to apply this guarantee or not. And there are like some conditions written in that legislation that, how it's formulated, only for defaulted cases of that financial instrument. How we define what is that? Is if the case of loan originator default is the case or not? I believe that before, so what we received as an answer from regulator, that they will clarify and they will get back with answer in the moment when the first license will be registered to someone. But I want to tell you, because we have to understand that this is risky business, yeah. It will not be. It will not be like in a bank deposit, and be careful. It's like what I would like to say. My message to investors: be careful if some platform manipulate with this 20,000 guarantee, because first of all, it will apply only for non-professional investors, and there are some rules. And it's a question how a regulator will interpret, for example, if you Stoicho as an investor on the platform, or on others, you invest already like for several years, maybe they will qualify you as a professional investor. I don't know. There is like also a checklist, and when you submit that checklist, based on that, maybe platform will define you as a professional investor. So we have to be careful with that.
In my case, I am. I know that this is the case, but I was asking for a casual investor, not me, because it looks like that this license will make the risk go away, which is not possible.
It's impossible. It's impossible for sure. Otherwise, the government will allow any loan originator just to track deposits. So what's the reason for that? It's the same like, let's say, factories will have like state guarantee for any deposit up to 20K. That will not happen for sure. And I want to.
My understanding about this looks like it's maybe not correct. As I saw, there is no clearance to the regulator, but it looks for me that if the platform go bust and cannot fulfill their obligations to the investors, the regulator should step in and maybe use this kind of guarantee or protection, investor protection or whatever. But if actually the financial instrument, it looks like if we get stock market, if I buy a stock, and if someone, this company goes bankrupt, should be compensated for it. So I have no any downside. It's not possible actually. Okay, I think this is the case, but still no clearance on this. But in any case, it's a very good step, because it will be hard to enter this market for fraudulent platforms.
Exactly.
Because I think the fraudulent platforms is the biggest actually risk for this industry, because it's very easy to make a fraudulent platform, and usually when the platform is fraudulent, it actually works like a clockwork. Everything is fine, no errors, every trades are good. I love Groupier about this. But currently something happened, and when something is too good to be true, usually it's not true. Yes. So, okay, I finished my questions. I just want to give you the opportunity to say anything you want to your investors.
Yeah, thank you very much for that. I want to emphasize, just if we already spoke about licensing, I would just emphasize that we are going to licensing process exactly to be on that, let's say, transparent manner. First of all, not to apply for that guarantee. And as to investors, my message is that especially in this time like we have now, it's more important to save your money, like save your investment, not to earn a high interest rate. We never chased high interest rate. In our platform, we probably one of the lowest in terms of return, but at the same time, we have, as we consider, we have a very low risk as well. And with investments, it's always important to save like principal, first of all. So that's what I would like to emphasize for our dear investors. And this is actually our targeted investor group. So we will never chase for higher return for you, dear investors, but we will do our best to save your investment, first of all. And yeah, that's we are open to speak about any topics. We are happy to disclose any additional information. Please approach us either to support or send us direct messages. We will be happy to answer, and hope the whole market will overcome this crisis. Will be more like stronger, more developed, and all participants, including loan originators, investors, marketplaces, influencers, everybody will participate in that common growth, and that will be like mutually beneficial.
Yeah, I think it's kind of cleansing process, because it was become way too easy to start a P2P platform, literally from scratch. And most people think that they need programming skills to do this, but it's actually not the case. It's kind of risky business, it's risky loans. But anyway, maybe if we summarize to message for investor, one for me at least: don't panic, but don't be greedy, because it's not time to be greedy and not time to panic. Okay, thank you very much for being such open and really transparent. I'm especially amazed by the level of transparency I saw about the answer to your due diligence process. I will be perfectly happy with the part that only you answered, because it's quite good answer, and the usual answer I get is something like your answer, but this answers that I get from Gytis was something very meaningful for me. Thank you.
Happy to hear that. Thanks for having us. And
thank you for Aforti. You saved me some money there.
Thank you very much.
Welcome. Bye.
Bye-bye.
Bye-bye.